Stop what you're doing right now. 24 hours ago, the most important meeting in precious metals history closed in Washington, D.C. 54 nations, J.D. Vance, Marco Rubio, and they didn't just talk about coordination, they created Forge, the successor to the Mineral Security Partnership, a 50-nation buyers cartel with one explicit goal: control the physical supply of critical metals before China does. And in the 24 hours since that summit closed, something fundamental changed in this market. The paper price still says silver is $87, but the physical market just decoupled. Completely, permanently. This is the Asian guy. It is Wednesday, February 5th, 2026. And what I am about to show you is not analysis of what might happen. It is documentation of what has already started happening in the 24 hours since governments announced they are taking control of this market. Let me give you the timeline, because understanding when these dominoes started falling is critical to understanding why the next 48 hours matter more than the last 48 months. Yesterday morning, February 4th, 9 a.m. Eastern, the Critical Minerals Ministerial opened at the State Department. J.D. Vance delivered the keynote. Marco Rubio hosted. 54 countries sent delegations. 43 foreign ministers attended in person. This was not a photo opportunity. This was the formation of a minerals OPEC. And here is what they announced. Forge, the Forum on Resource Geostrategic Engagement, the official successor to the Mineral Security Partnership, chaired by South Korea through June, with one mandate: coordinate strategic buying across 50-plus nations to reshape the global market for critical minerals. But Forge was not the headline. The headline was the mechanism, the tool they are going to use to control supply. Two words that Wall Street hoped would never be spoken in official government policy: price floors. J.D. Vance stood on that stage yesterday and explicitly stated that the United States and its allies will establish strategic price floors for critical commodities including silver. Not price ceilings, price floors. They are not trying to cap the price. They are preventing it from falling. They are saying to the market, we will not allow paper manipulation to drive prices below the cost of production. We will step in as buyers of last resort. We will deploy government capital directly into mining and stockpiling. We will become the bid that never disappears. Think about what that means. For 50 years, the game was rigged downward. Banks could smash the price anytime they wanted. Spoofing, front-running, coordinated contract dumps. They did it to keep the dollar strong and metals weak. But as of yesterday, that game ended. Because now, if JP Morgan tries to smash silver to $80, they are not just fighting retail investors or hedge funds. They are fighting a 50-nation coordination framework with unlimited capital and zero time preference. The government floor becomes the new reality. And once that floor is set, the only direction is up. Yesterday at 11:50 a.m., they took the family photo. 54 nations standing together, announcing they are forming a buyer's cartel for the same metals that Wall Street has manipulated for decades. And by yesterday evening, the first order effects started showing up in the physical market. Here's what happened in the 24 hours since that summit closed. And this is where it gets real, because I am not talking about predictions. I am talking about confirmed movements in physical supply chains that started the moment governments announced coordinated intervention. First movement. U.S. mint rationing accelerated. The mint was already limiting Silver Eagle production due to blank shortages from refiners. But yesterday afternoon, dealers started reporting that allocations for February delivery just got cut again. Not by 10%, by 30%. The mint cannot get enough blanks because refiners are prioritizing something else. Government contracts, Department of Defense orders, strategic reserve stockpiling. When a refiner has to choose between making blanks for retail coins and fulfilling a military contract, there is no choice. Defense wins. And according to yesterday's State Department briefing, defense orders are about to surge because national security infrastructure build-out is now a coordinated priority across all 50 nations. Second movement. Primary dealer premiums spiked. I track institutional pricing through direct relationships with primary dealers. Yesterday morning before the summit, you could order 1,000-ounce bars at spot plus $2 with 4-week delivery. Last night, that same order was quoted at spot plus $3.50 with 8-week delivery. That is not a premium increase, that is a rationing mechanism. The physical market is pricing in the knowledge that governments just announced they are becoming the dominant buyers. And governments do not negotiate on price, they pay what it costs and they take delivery. That pushes retail and small institutional buyers to the back of the line. Third movement, state depositories accelerated procurement. 26 U.S. states have either passed or introduced legislation allowing state treasuries to hold physical precious metals as reserve assets. Texas, Utah, Wyoming, Oklahoma. They are not just passing laws, they are building vaults, hiring security, implementing chain of custody protocols, and yesterday's summit gave them the political cover they were waiting for. When J.D. Vance stands on a stage and confirms that metal-backed policy is under serious federal consideration, when the State Department hosts 54 nations to announce coordinated government buying, state legislators who were nervous about being called gold bug extremists suddenly have justification. The vice president just validated their strategy. The result? Procurement timelines that were measured in quarters are now being measured in weeks. State treasurers are not waiting for lower prices. They are executing allocation targets because compliance with the law is more important than execution quality. And when you have 26 states competing for the same limited physical supply, while 50 nations are doing the same thing internationally, the available inventory disappears fast. Fourth movement. ComEx registered inventory drain accelerated. Registered inventory is the metal actually available for delivery against futures contracts. Yesterday morning, registered silver sat at approximately 38 million ounces. This morning, it dropped to 36.2 million ounces. That is 1.8 million ounces drained in 24 hours. In a normal market, that would be alarming. In a market where 50 governments just announced coordinated buying programs, that is catastrophic. Because those 36 million ounces are not just sitting there waiting for whoever wants to buy. A significant portion is already committed. Lease agreements, forward contracts, industrial offtake arrangements. The truly available supply is much smaller than the number suggests. And now you have state governments, federal strategic reserves, and 50 international coordination frameworks all trying to secure physical delivery simultaneously. Let me connect these four movements, because individually they are concerning. Together they prove the paper market just lost control of physical supply. The mint cannot get blanks because refiners prioritize government contracts. Primary dealers are rationing institutional orders because they see what is coming. State depositories are accelerating procurement because political cover just arrived. ComEx inventory is draining because entities with infinite time horizons are taking delivery. This is not coincidence, this is coordination. This is what happens when monetary policy, industrial strategy, and geopolitical security converge on the same asset. And it all started 24 hours ago when governments announced they are taking control of this market. Now let me show you why the next 48 hours matter more than the last 24. Because the summit announced intentions, but intentions do not move markets. Execution moves markets, and execution is starting right now. Project Vault, announced 2 days before the summit, a $10 billion export-import bank loan plus $1.67 billion in private capital to create a domestic strategic reserve for critical minerals. That is $11.67 billion in government-backed capital that will be deployed directly into mining, processing, and stockpiling. Not over years, over months. The Exim board already approved it. The capital is allocated. The only question is which projects get funded first and how fast they can scale. But here is the critical detail most people missed. Project Vault is not just about building future supply, it is about securing existing supply. Offtake agreements with producers, forward purchase contracts with refiners, direct relationships that bypass exchanges entirely. When government capital starts flowing into strategic reserves through Project Vault, that metal never touches the spot market. It goes straight from refiner to vault, permanently removed from trading float, committed to entities that do not sell, and Project Vault is just the US program. Now multiply that by 50 nations executing similar frameworks through Forge coordination. Every bilateral agreement signed under Forge is metal that never reaches ComEx. Every government-to-government offtake arrangement is supply removed from market pricing. The paper market sets prices based on the assumption that physical supply is fungible and available. But when governments lock up supply through strategic frameworks, that assumption breaks. You get backwardation, front-month physical trading at premiums to deferred paper. That is what is starting to show up right now. Look at the futures curve. 2 weeks ago, the curve was in contango, deferred contracts trading higher than near-term, normal market structure. Yesterday, the front month flipped into backwardation. Near-term physical now worth more than deferred paper. The market is pricing in settlement risk. The risk that when your contract comes due, the clearinghouse cannot source metal because it has already been allocated to government programs. And when settlement risk becomes a pricing factor, you are not in a bull market anymore. You are in a structural breakdown. Let me give you the math that explains why this breakdown is accelerating. Industrial demand consumes 985 million ounces of silver per year. Mine supply produces 822 million ounces. That is a 163 million ounce deficit annually. That deficit has to be filled from above ground inventory, recycling, scrap, existing stockpiles. But here is the problem. Above-ground inventory is not infinite, and it is not equally distributed. A significant portion sits in vaults that are now being locked down by government programs. When 50 nations coordinate strategic stockpiling, when 26 U.S. states build depositories and start accumulating, when Project Vault deploys $11.67 billion to secure supply, that above-ground inventory becomes unavailable. It is not coming back to market. It is not available to fill the deficit, which means the deficit gets worse. Industrial users still need 985 million ounces. Mines still only produce 822. But now the 163 million ounce gap cannot be filled from inventory because governments control that inventory. The only way to balance the equation is price. Price has to rise high enough to either reduce industrial demand or incentivize enough new mine supply to close the gap. But new mine supply takes years to bring online. Exploration, permitting, construction, ramp up, you are looking at 5 to 10 year timelines, which means for the next 5 to 10 years, the only variable that can adjust is price. And here is where government price floors become critical. Normally when prices spike, banks step in and smash them back down. Spoofing, coordinated selling, margin requirement increases. They have a toolkit for capping rallies. But if governments have established price floors, if they have committed to being buyers of last resort, the banks cannot smash the price without fighting entities that have unlimited capital and zero time preference. JP Morgan cannot win that fight. No bank can. The price floor holds. And when the floor holds, the only direction is up until supply and demand balance at a new equilibrium. But that equilibrium is not $87 silver. It is not $100 silver. The math says it is significantly higher, because you have to price silver high enough to either destroy industrial demand or incentivize enough new supply to close a 163 million ounce annual deficit. And you have to do it while governments are stockpiling, which makes the deficit worse, not better. Now layer in what is happening at the state level, because this is where most people are not paying attention, and it is where the next wave of buying pressure comes from. 26 U.S. states have legislation allowing precious metals as reserve assets. Not all 26 have allocated capital yet. Some have passed the laws but not funded the programs. But yesterday's summit changed the political calculus. When the vice president confirms metal-backed policy, when the federal government announces strategic reserves, when 50 nations coordinate buying, state legislators who were on the fence suddenly have cover. The federal government just validated the strategy. The international community just endorsed it. Political risk just dropped to near zero, which means states that were hesitating are now moving forward, and states that were already moving forward are accelerating. Let me give you the numbers. If just 5 of those 26 states allocate 1% of their reserves to physical silver, you are looking at approximately $2 billion in capital, hitting a market that trades 43 million ounces per day on ComEx. That is 23 million ounces of demand at current prices, executed over weeks, not months, because state procurement moves fast once legislation is funded. ComEx registered inventory is 36 million ounces. If 5 states buy 23 million ounces, that leaves 13 million ounces for everyone else. Industrial users, retail investors, hedge funds, international buyers. 13 million ounces to satisfy global demand outside of U.S. state programs. That is before you add federal strategic reserves. Before you add the other 45 nations executing forge coordination. Before you add private sector industrial demand that consumes 985 million ounces annually. The math does not work. There is not enough registered inventory to satisfy coordinated government demand plus existing industrial and investment demand. Something has to give. Either the price gap's higher to ration supply through price, or ComEx defaults on delivery obligations and settles in cash, or both happen simultaneously. And when I say default, I do not mean ComEx shuts down. I mean they invoke force majeure, they change the rules mid-game, they announce that physical settlement is suspended and all contracts will be cash settled at a price determined by the exchange. That price will not reflect true physical market value. It will reflect whatever prevents systemic collapse of the paper market, which means if you are holding paper silver, you are exposed to settlement risk that is now being priced into the futures curve through backwardation. Physical delivery is the only trade that eliminates that risk. But here's the problem. You cannot get physical delivery at the paper price anymore. The disconnect has already started. Primary dealers quoting spot plus $3.50. Retail premiums at spot plus $4 to $6 depending on product. Delivery windows extending from 4 weeks to 8 weeks. That is not normal market friction. That is rationing. The physical market is telling you that supply is constrained and getting tighter. And it is tighter because governments are becoming the dominant buyers. State depositories do not sell. Federal strategic reserves do not sell. International coordination frameworks do not sell. They accumulate and hold with infinite time preference. Once metal goes into a government vault, it does not come back out unless there is a constitutional crisis or a strategic emergency. You are watching supply get permanently removed from the trading float by entities that do not care about price. And that removal is accelerating because political cover just arrived from the highest levels of government. This is the feedback loop that most people are missing. Government buying legitimizes metal as a reserve asset. Legitimacy reduces political risk for other governments. Reduced political risk increases participation. More participation removes more supply. Less supply pushes prices higher. Higher prices validate the strategy. Validation encourages more governments to participate. The cycle reinforces itself until something breaks. Either the paper market breaks and physical decouples completely, or the price adjusts violently higher to a level that balances supply and demand in a government-controlled market. Both scenarios lead to the same place. Paper silver becomes irrelevant. Physical silver becomes the only trade that matters. Yesterday's summit was not about making plans. It was about announcing that the plans are already being executed. Forge is operational. Price floors are policy. Project Vault is funded. State depositories are accelerating. 50 nations are coordinating. This is not coming. This is here. This is happening right now. In the 24 hours since that summit closed, the physical market started decoupling from the paper price. Mint rationing, dealer premiums, state procurement, ComEx inventory drains. All accelerating simultaneously, all pointing in the same direction, government control of physical supply. And when governments control supply, markets do not function on traditional supply and demand dynamics anymore. They function on allocation. Governments get first priority, strategic industries get second, retail gets whatever is left, if anything is left. This is the new structure. This is what happens when 54 nations stand together and announce they are forming a buyer's cartel for the same asset that Wall Street has manipulated for 50 years. The manipulation era is over. The government intervention era has begun. Not next year, not next month. Now. Right now. The summit closed 24 hours ago. The first order effects are already visible. Mint rationing, dealer premiums, inventory drains. The second order effects are coming in the next 48 hours. More states announcing procurement, more Forge bilateral agreements, more Project Vault capital deployments. And the third order effects, the ones that break the paper market completely, those are coming in weeks, not months. The only question is whether you are positioned before the break or whether you are trying to chase physical supply after governments have locked it down. Because once state depositories start taking delivery, once federal strategic reserves start accumulating, once 50 nations start executing coordination frameworks, the available supply for retail and small institutional buyers shrinks to near zero. You will not be buying at spot plus $3, or you will not be buying at spot plus $10. You will be trying to source metal that is no longer available at any price because it has been allocated to entities that do not sell. February 4th, 2026. The day 54 nations announced they are taking control of the physical silver market. February 5th, 2026. The day the first order effects started showing up in supply chains. 24 hours between government announcement and market reality. That is how fast this is moving. That is how little time you have to position before the physical market decouples completely. This is the Asian guy. The government takeover is not coming. It started yesterday. The physical market is already reacting. The paper market has not figured it out yet. That is your window. That is the gap where you can still act. But the window is closing, not in months, in days. Because when ComEx registered inventory hits critical levels, when state procurement orders hit the market, when Forge coordination starts executing at scale, the paper price becomes irrelevant. The only price that matters is the price you can actually secure metal at. And that price is set by governments who do not negotiate, who do not care about your cost basis, who do not sell, who accumulate with infinite time horizons and unlimited capital. Silver at $87 is not the top. It is not even the middle. It is the last moment before governments finish taking control of supply. Position accordingly.